Hey there, fellow investors. Today, we're talking about the one and only Michael Burry, the man who predicted the housing bubble burst before it even happened in 2008. That's right, he saw it coming from a mile away, while others were still scratching their heads. But did you know that he's been making some seriously accurate calls lately? The Maverick made a big bet on the financial system and ended up making almost $100 million. How did he do it, you ask? By investing in credit default swaps on subprime mortgage bonds. So sit back, relax, and let's dive into the fascinating world of Michael Burry. We'll be talking about the wild ride of inflation, the bursting of the white-collar job bubble, the epic fall of meme stocks like AMC and GameStop, and the surprising failure of Bitcoin to become the world's reserve currency. Let's get right into it. Michael Burry has an odd talent for making precise predictions. Now he's turned his attention to the current bull run in the stock market, and according to Burry, things might not be as rosy as they seem. In a series of intriguing tweets, he shares his concerns about the short-term balance in the market and the potential for a significant decline. Burry considers the S&P 500's increase of more than 14% since the market bottomed in October to be short-term balance. He has previously emphasized that there have been multiple brief market rallies during prior financial crises, within a far more prolonged downward trend. This time, Burry is using Twitter to share an important fact that may have stopped the stock market crash from happening. On March 30th, he joked that no generation has been buying the effing dip since the 1920s. At the same time, he said that people are still putting money into the stock market, even though the economy is in bad shape and company earning reports have been disappointing. Burry says that the average gain after bad days on the stock market has gone up a lot over the past few years, especially over the last year. Over the course of a single day, the average return was about 0.3%, which shows that a lot of money continues to flow into the market even when it goes down. This shows that investors still think the stock market is a good place to spend and don't see it as hard. As long as people keep having good thoughts, it's likely that the market will keep going up. This graph from Street Global Advisors demonstrates how in 2020 and 2021, cash flows into exchange-traded funds or ETFs considerably rose and exceeded $900 billion. Even though interest rates and prices were going up in 2022, inflows stayed high at $589 billion. This shows that investors were still putting a lot of money into the market, which backs up Burry's claims that investors' views of the market haven't changed much. The number showing low cash inflows at the start of 2023, which is the lowest since 2019, suggests that the market may not be getting as much cash as it used to. This could mean that the buy the effing dip attitude that Michael Burry has talked about is starting to go away. Commodity, specialty, and alternative funds had combined net withdrawals, while stock and bond funds had inflows that were 85% and 90% below their long-term monthly norms, respectively. Because February flows were low and January flows were below average, this year got off to one of the worst starts ever. The first 2 months of the year brought in a total of $49 billion, which is the worst start to a year since 2019. Back then, like now, the market was going down and the Fed was rising interest rates. Burry says that buyers have temporarily helped the market by buying the dip, but this effect is likely to wear off soon. Recent trends in how consumers spend and save, as well as the fact that interest rates keep going up, back this claim. When interest rates go up, people have less money to spend, which makes it harder for them to pay off bills like mortgages and car loans. The cost of living is also going up because of the high rate of inflation, leaving less money for other things. The US has very low personal savings rates, which means most people don't have extra money to spend. Also, there will be probably less borrowing because credit is about to get tighter in response to recent bank shocks. This could make it harder to get money to spend. According to this research, the current buy-the-dip mentality, as well as market support, may be on its way out. Michael Burry has long predicted that if there is no support, the market will plunge again. In prior tweets, he referred to the market recovery as a dead cat bounce, and claimed that we had only gotten halfway down the negative slope. He compared the current situation to the midway rally that occurred during the S&P 500's collapse in 2001. Furthermore, he said that the current crisis took more than 10 years to prepare for, making it unlikely that everyone will be out in a year. This means that if the market falls during the next year, it might lead to a prolonged downturn if investor capital inflows convert to outflows. While it is fascinating to follow Michael Burry's thoughts and ideas on the market, we should keep in mind that this type of information shouldn't influence our own investing decisions. There may not be much to learn from his predictions without taking into account the situation of the market. Burry's short-term market forecasts are unlikely to have a big impact on active investors. Active investors concentrate their efforts on acquiring specific companies at reasonable prices, so that the companies fall within their circle of knowledge. This strategy doesn't require any market research, although having a thorough understanding of the present state of the economy can be beneficial. Macroeconomic studies and stock market forecasts will not be of much assistance to active investors. It's critical to remember that someone like Michael Burry is playing a game that is very different from the one in which the bulk of us are involved. Despite the fact that he clearly pursues investments with a value-oriented mindset, his 13F filings show that he performs more like a trader than a long-term investor. If you examine his 13F history, you will notice no evident patterns. He rarely holds a position for more than 3 months, and he will occasionally make short-term option bets on market direction. When we look at Warren Buffett's 13F filing, we see relatively little change in his quarterly filings. Both Burry and Buffett are value investors, but Buffett is more interested in buying a firm and watching its value rise over a 10-year period. Michael Burry, on the other hand, concentrates on exploiting short-term mispricings over a period of weeks or months. While some people may find this type of investing intriguing, a lot of us may not think it's a good idea. And that's a wrap for today's video. We hope you liked learning about Michael Burry's stock market observations. Remember that investing is a personal experience, and you must evaluate your own investment strategy, as well as your risk tolerance. Do you believe the buy the dip mentality will die out, or do you expect the market to continue its upward trend? Leave your opinions in the comment section below. If you found this video useful and instructive, please like it, subscribe to our channel for more engaging stuff, and set on notifications to keep up with our latest uploads. Thank you very much for being here today. Until next time, happy investing, and may your portfolios prosper.